Welcome back. I'm Ryan Mumy, and with me is Justin Greenhill, and we're with Sollinda Capital Management. And this is another episode of Chart Overload. Lots of good stuff going on out there, Justin. Never a dull moment for the markets. Let's dive right in with the big picture. Obviously, right now at the center of what's going on in the marketplace with all asset classes, not just the stock market, is the tariff dynamic, and specifically between the U.S. and China.
Yep. I think unless you've been living under a rock, everyone would say that is front and center of attention. This first chart here basically shows the black line, the U.S. tariffs on most goods from China, and Chinese tariffs on the U.S. And as you can see, prior to April, it was 10 or 15% of Chinese goods coming into the U.S., and it has since recently shot up to well over 100%, which is pretty stunning when you think back to January it was zero.
Yeah, and what's been the response mechanism is U.S. Companies are just not importing stuff. They're sending ships back to China or telling them to unload the boats, and there's a delayed effect, so we haven't really experienced the potential supply issues, but that's the fear. And moving on this topic is that the U.S. trade deficit, despite this, has gone up, which is kind of the opposite of intended outcomes.
Well, I think to your other point, one of the reasons that most recently it's gone up has been a lot of people, or a lot of firms, I should say, people and companies, rush to import a much larger amount of goods than they probably normally would have in order to get them in before the tariffs took effect. So bottom left, you can see the trade balance, which is just exports minus imports, and then on the right you see U.S. imports, and that most recent tick up is almost certainly credited to so-called front running of people wanting to go ahead and stock the shelves or stock inventory before the tariffs, which this is something we can talk about a bit later on when we touch on inflation. But bringing those goods in a bigger amount before tariffs, if anything, might create some near-term additional supply, which could actually cool inflationary pressures before they potentially pick back up. So another layer of uncertainty to the whole situation.
Yeah, and moving on, looking at broader U.S. economic data, there continues to be a big disconnect between the so-called hard data, employment numbers, etc., and soft data, which is more surveys. How are you feeling? What do you think about the future?
Exactly. So the blue line here is the so-called hard data. So as you said, Ryan, think of the employment data, think of GDP, think of economic data that has, already happened. So backward looking, versus what is the yellow orange line is the survey data or soft data, which is effectively, polling of different types of businesses and economic participants of what do you think about the future. And normally you don't see this big of a divide between the two. However, as you can tell in this chart, beginning of 2023, earlier part or the first half of last year, you do see instances, especially in the last several years, where the sentiment data can get overly negative. But at the same time, you also can see instances where it can lead the actual hard data. So again, it's it's hard to make a very high conviction prediction of which one is leading and which one is going to catch up to the other one or revert to the other one.
Yeah, it's like we've talked about in the past. Everybody wants a silver bullet and wants you to think there's a silver bullet. There's one data point to take action on, and this is one of them that we don't believe is so. It's one that in hindsight, it'll make perfect sense, but any action you make today, it has to be weighted in addition to other data. Which is why we do chart overload, to give you an example of the things we're looking at and weighing into our decision-making process. Let's move on to the Fed. The market is pricing in, I think, 3 rate cuts, or it was 3 rate cuts this year, but inflation is limiting the Fed's response. And just today, as of recording this, the Fed has held rates steady as expected.
Yep. So the chart on the left here is basically what the market thinks the Fed is going to do between now and the end of the year. So at present, it's looking to get roughly 325 basis point rate cuts. But as you'll see on the chart there to the right, the expectations implied in the market of inflation are still well above the Fed's target of 2%. So both of those probably won't be right, in that we ultimately feel that, if inflation expectations stay high or go higher, and the so-called, hard economic data that we mentioned a second ago stays firm, it's quite possible the Fed might cut less than 3 times between now and the end of the year. So we'll just have to see.
Yeah, and moving on to the next slide, just like we talked about, part of what's limiting the Fed's ability to cut is, to these two charts here, the domestic market, job market continues to be strong, and the pesky inflation continues to stay up beyond where the Fed's mandated level.
Yep. And the payroll data, which comes out once a month, is arguably your classic, most core indicator of what's going on with domestic employment, which, as you can see in the left graphic here, has stayed strong of late. But what's interesting too is there's a lot of good analysis being done out there that shows, this may be a less effective measure than it has been in years past, due to, the ability to engage in the gig economy, the ability to take on 2 jobs, so on and so forth. So if you were to take a negative view, one could say that relative to other periods in history, this could go from very stable to actually start to drop off in terms of change in payrolls pretty quickly.
Yeah, and that the rate of change could be substantial. There could be some big swings. We're talking about some uncertainty out there. We're not making a call on the markets, but this next slide, we know based on data where most retail investors are going, and based on this slide, they're buying lots of equities, and specifically, they're using some of the available index funds that have some embedded leverage inside of them.
Yep, and that's fairly new to this cycle, in that recently, in the last few years, there's just been an explosion of these levered ETFs available to trade. And, the market, when it's gone down over the last few years, it's been right back and up and to the right in pretty short order. So as a result, despite, what looks to be pretty substantial economic risk going forward, a certain participant, in this case, we believe it to be retail, is buying the dip.
Yeah, I mean, last month, according to the Bank of America data, flow data, it was the largest month on record of U.S. investors purchasing equities. So again, it's just interesting data, interesting for us to observe. We're going to move on to the next section now. Let's get into U.S. stocks. What charts out there are piquing our interest? This first one just shows a chart going back a couple of years with the S&P 500, and Justin's art degree is paying off here, showing just a critical level is where we're at right now.
Yeah, it's interesting how markets work sometime, in that basically after falling pretty substantially in short order at the early part of April, post the announcement of these massive tariffs on trading partners by the Trump administration, the market bounced back to pretty much exactly where it was the close of trading just prior to that tariff announcement. And since then, and through today, it's basically pulled back from that point. So we're not saying that this is a magic line by any stretch, but it's hard to be really high conviction on an uptrend taking place if the market is below this level.
Correct, because historically they have, if you go back to the beginning of the chart, the far left, you see that same level was a resistance level, and then you see it recently bounced right below it and came back up, so it acted as support. And those types of lines end up being resistance and support. So to our conversation, to what Justin said, if we get above it, that same line that's showing to be a resistance level could turn into a support level. So again, this doesn't mean we're taking action based on this or recommend taking action. We're just saying this is something that's the weight of the evidence, how we're making decisions right now. Next one, again, back to this kind of dichotomy right now on what direction do the markets go. The path could literally go both ways.
Yeah. If you want to find a chart that doesn't give you any solid conviction based on history about what's going to happen in the market, this is it. So, one thing you can take away from this is that the recent drop has been sharper than what has been the average, move lower, the initial move lower. And the recent jump back has also been sharper. So more volatility, but ultimately from here, if this is a bull market, we're going to need to see additional evidence where it would become the red pink line. And, if in fact this is a bear market, which would be the yellow orange line, then the path of least resistance would no doubt be lower. So we're at kind of a fork in the road, at least in terms of very basic price analysis.
Yeah, that's it with U.S. stocks. Let's move on to non-U.S. stocks, and it's all primarily it's driven a lot by the U.S. dollar, and this first chart just shows the bloodshed that has been in the greenback so far in 2025.
Yep. So, an 8% drop in the dollar index. This is the Bloomberg dollar index, which is basically a trade weighted versus the trading peers. So, euro obviously being a big piece of that, but quick 8% drop year to date, back to where we were, ultimately last summer. And the, consensus around this has really just started to shift, that there is now various different catalysts that are going to potentially bring money out of the U.S. that, is the reversal of what has been a tremendous amount of money into the U.S. over the past several years. So the currency reflects that.
Yeah, and the non-U.S. equities have outperformed their U.S. counterparts so far this year, which we've talked about. And this next chart shows that despite this, valuations from a historical standpoint still remain more elevated on U.S. listed shares than they do on their, in this instance, their Europe counterparts.
Yeah, we find this chart to be really interesting, and the reason is that if you look at a chart of valuations for stocks and you look back multiple decades, you could make the argument that companies are more advanced, more technological, and thus there's a reason that valuations are higher now than they were, say, in the 80s or the 70s or maybe even the 90s. But this chart only goes back to 2010. So when you see the S&P 500, despite its recent move lower, still trading this high above its 10-year average, it just shows that there needs to be a lot of good news coming to basically justify that going higher. And on the flip side, European stocks, which have done well this year and benefited from what has been a rotation of capital out of the U.S., are still notably cheap.
And moving on to the bond market, interest rates and fixed income. This first chart just shows the range of the 10-year U.S. yield, U.S. Treasury yield, literally for 2 months. That's what shocked me when we put this together. Is that's not a long-term chart. That's literally 60 days.
Yeah, so there was a moment there in April where it looked like rates had spiked, bonds had crashed. There was a moment just before that where bonds had done extremely well, rates had dropped, but ultimately we've just sort of traded sideways. So similar to kind of where we are in the stock market right now, there's not a whole lot of price evidence to suggest there's a trend in either direction, just a lot of volatility.
Yeah, and what drives the 10-year? The 2-year, the shorter end of the yield curve or the maturity curve is driven by Fed policy, which we already covered. Right, the market's anticipating 3 rate cuts. Who knows with the Fed? They keep saying they're going to be data dependent and be patient. The 10-year and the 30-year are driven by market participants' expectation on future inflation and economic growth. Right, so if inflation's up economic growth is positive, you'll see the 10-year traditionally creep higher, and vice versa. If things are slowing down, you'll see that that move lower. So to Justin's point, the 10-year yield, the direction it ends up taking, it's going to be driven by other forces that oftentimes will tip its hand well in advance.
Yep.
Moving on to the next one, just one subcategory of the bond market, the municipal bond market. We've seen some stress there recently, some untraditional volatility in the pricing of those issues, where states and municipalities issue bonds to support their communities.
Yeah, and there's a few reasons for that, but one of them that we found interesting in this graphic is just the number of $1 billion plus natural disasters that have occurred, that have ultimately been in part or fully covered by municipal issuance has jumped up pretty substantially the last 2 years. So obviously that's a bigger expense that municipal governments have to cover, which often means they need to attract more capital by charging higher interest rates, which is lower municipal bond prices.
Moving on to the next section, we'll get into some commodities, and the big one, the black gold, oil, has not picked up with the rebound in the stock market. It's actually went lower on numerous factors.
Yeah, and I don't know if anyone recalls what was our, early year video, but basically, we were talking about how many people were saying that there was a narrative for oil to go much higher, and ultimately, that's been wrong, really going back all the way to 2022. And what's basically happened is, oil's a speculative asset. So even though it's used in the real economy, it's also used to express a view, either positive or negative, on the outlook of the global economy. And due to tariffs, due to, other factors, mostly tariffs, the collective, view is that the economy is going to slow. At the same time, we've had a situation where OPEC Plus, as they're now called, led by Saudi Arabia, has aggressively signaled that despite the expectation for weakened demand, they're actually going to be increasing their output of oil. And the reason being is they say it's necessary to kind of make sure that other OPEC members stop cheating on their output. And at the same time, there's conspiracy abound that this is sort of a favor to the Trump administration, because ultimately this is going to lower gasoline prices here domestically and be a headwind to inflation.
Yeah, it's going to help bring inflation down. Again, we'll see. That is something we pay attention to, simply because so many different factors go into it, as Justin just did a great job laying out. So it's something we're paying attention to. Does it confirm other things we're seeing, or is it in the other direction? And next in commodities, gold's been on a run. Despite some of the backdrop, not traditional economic backdrop, not necessarily being there what would traditionally support gold prices, it's done very well, and this chart pretty clearly shows why.
Yeah, so it's emerged that China's been a big buyer of gold, really going back to late 2022, 2023, and although we'll never know for certain, what it ultimately looks like is that during that period of time, there was some pretty significant sanctions and confiscation of U.S. dollar-based reserves put onto Russia. And at that particular moment, it looks like China, as well as some other governments, started to, on the margin, diversify and buy gold. And since then, it's taken on a life of its own in terms of, be it funds globally or individual participants have done the same.
Yeah, if you think oil's speculative in nature, gold's that times 5 on the number of folks that are trying to speculate on the future price. And we want to close today with just kind of a takeaway, right? Because there are, as we've laid out here, there are kind of dueling ideologies or thoughts on the direction of the market. And we wanted to just briefly cover both of them and talk about it a little bit. So the first one is that we're in this complacency stage where markets go up, nothing can go down. that it hits that euphoric area, and then it drops sharply, and then it rebounds. And if you look back over history, this happens numerous times on various cycles. And so we have this whole group segment of the marketplace participants that are saying we're in the complacency phase, watch out below.
Yep, and that makes sense, assuming that one does think that this was a euphoric bubble. But not all tops and then corrections in the stock market are that. Some are fairly routine. And to the bottom chart here, this basically shows that a certain type of systematic market participant. So strategies that, buy more aggressively when volatility starts to drop and buy more aggressively when strong upward price trends develop. These participants, as a large general category, you can see in the red line on the chart here that they've basically already sold and are just now maybe starting to re-enter the market from depressed levels. So in order to get these participants really consistently back buying the market, we're going to need to have volatility stay relatively tame. And back to some of our prior charts, we're going to have to see a more definitive uptrend establish itself in the market.
Yeah, and that's the dichotomy, right? The difference. I think that's my word of the day. I think I've used it twice. Is we've got these two schools of thought, and the first one, they could be right, and then you have the second one that says, look, most of the firepower in buying doesn't come from retail investors. It comes from these systematic institutional investors that have no emotion. It's all, again, if this, then this, if this, then this, completely systematized, where they're extremely underinvested right now from a historical standpoint, and there's massive buying power there, right? So who wins, we don't know. And Justin and I were talking about this early in preparation for this, that it could be both, right? What's your time frame? It could be over the next several months before we get any data trickling in that reflects the slowdown in global trade. It could be that the systematic strategies absolutely drive the markets up, or at least stabilize some of the buying pressure that's coming from other market participants. And then hard data could roll over, and we could see some more struggles in the stock market, or it could not come. We could get all kinds of trade deals done, and it's an afterthought. So that's, again, we wanted to reiterate that right now is have a relationship with your money, because we are not on the solid footing we've been for the last several years.
Yep. And again, don't necessarily try and make some sort of big call and stick with it, because the situation is very fluid. And in terms of a lot of these indicators, a lot of it is path dependent. So things can change pretty quickly.
But we appreciate you tuning in. That's all we got for this episode of Chart Overload. Again, we're with Sollinda Capital Management, Justin and I, co-founders. If you have any questions about anything we talked about, if you want to, if you're an advisor, you want to learn a little more about what we do and how we help our advisor partners, reach out to us at info@sollinda.com. Info@sollinda.com. Again, we appreciate you tuning in, and we'll be back next time.